Hi, good morning, everyone. Thank you so much for attending this section on climate change in the insurance industry. My name is Anya Prince, and I'm the chair-elect of the insurance law section for AALS. And I also want to thank our co-sponsor groups, the environmental law section and the business association section. So thank you so much for coming. I'm going to briefly introduce all four of our panelists, and then they will speak in order, and we'll save questions for the end for the entire group. If you have questions as they're speaking, feel free to type it into the chat function, and we'll monitor that and save them for the end. So our speakers today in order are Chris French. He's a professor of practice at Penn State Law. Professor French currently teaches torts, trial advocacy, evidence, contracts, and of course, insurance law. And he's written and published extensively in the area where insurance law intersects with contract and tort law, and also has written quite a bit in climate change and climate risk and insurance of late. Dave Jones is our second speaker. Dave Jones is the director of the Climate Risk Initiative at UC Berkeley's Center for Law, Energy, and the Environment. And he served previously 2 terms as California's insurance commissioner from 2011 to 2018, where he launched several climate-related initiatives as a regulator there, and worked a lot with NAIC on that as well. Dr. Carolyn Kowski is the executive director at the Wharton Risk Management and Decision Processes Center at the University of Pennsylvania, where she also directs the policy incubator. Dr. Kowski's research has examined multiple aspects of disaster insurance markets, such as the National Flood Insurance Program, federal disaster aid and response, and policy responses to potential changes in extreme events with climate change. And last but certainly not least is Alex Lemon. He's an assistant professor of law at Marquette University Law School, and Professor Lemon joined the faculty of Marquette in 2017, and his primary scholarly interests are the fields of tort law, insurance, and environment, particularly how the design of legal systems address human responses to risk. So I'm really excited to have all these panelists speak to us this year. I know there have been so many world events in 2020 that we're reflecting upon, but not to be forgotten are California wildfires, hurricanes in my own state of Iowa, derecho, which I just learned was the 3rd largest weather event this year. And so it's a really important topic for us to be looking at about how the insurance industry is going to handle these changes. So thank you so much, and we look forward to your questions and all the presentations. So Chris, take it away.
Yeah, thanks, Anna. Trying to share my slides here with everybody. All right, folks, so I thought I'd kind of kick us off with a little bit of background just about climate change in general and how it impacts insurance issues. Most of you probably are fairly well versed in some of these topics already. But as Anya just sort of alluded to, 2020 was a terrible year, not just because of the pandemic and all the other issues going on, but it was also the worst year ever for hurricanes and wildfires, both in terms of number and scope. So starting with floods and hurricanes, as some of you may or may not know, they account for roughly 90% of all natural catastrophe damage in America. They average about $8 billion a year, so that totals roughly $240 billion over the past 30 years. And then last year, as I mentioned, was the worst year ever for hurricanes with 30 named storms. It wasn't necessarily the worst all time for the amount of damages, but for the number of named storms, it was. So just to kind of give you a visual image to remind everybody what the impact of hurricanes can be, that's a home after it's hit by a hurricane. And here's a shot of somebody who's trying to recover from a flood. So the reason I included this slide is to remind everybody, because it's a little bit forgotten sometimes in academic circles when we talk about this, but floods impact everybody. All these natural catastrophes impact everybody. A lot of people think of hurricane damage and floods. They think of it as sort of a rich people's problem because they think of coastal homes, McMansions being hit by hurricanes and floods. But the reality is the vast majority of damage impacts poor people disproportionately to wealthy people. So this is just not a 1% person problem. This is across all socioeconomic backgrounds and areas of the country. So for those folks out on the West Coast, you know all about this. Wildfires are they're a huge problem. They have been for a long time, but in the past 20 years, they've really exploded. 9 of the 10 worst years all time have occurred in the last 15 years. 2017, 2018 had dramatic amounts of damages, $32 billion in losses. That's not including like business interruption losses, lost tax revenue. That's just property damage. More than 100 people were killed. And then last year was the worst year ever as far as the number of acres burned. I'm sure Dave can talk quite a bit about this from his time in California and is included today. But it wasn't just California this year. A lot of these recent years has been primarily California getting the worst of the wildfires. But this year it was Washington, Oregon as well. The whole West Coast was suffering from them in ways they hadn't in every year. But the last 20 years, there's no question that climate change is what's driving a lot of the wildfire problems out in the West Coast. Currently, we have about 40 million homes worth roughly $187 billion that are high risk for wildfires. And that's what a neighborhood looks like after wildfires come through it. You see the pools are left, but not much else. Part of the problem, this is why we know there's a connection with climate change, is that the number of months in a wildfire season is essentially doubled in some parts of the country. Out on the West Coast, it's increased by roughly 3 months each year. But if you go to more of the Southwest, Oklahoma, Texas, it's essentially doubled. So you have twice the amount of time where you have wildfires at risk, and consequently, you're having much more damage. And of course, because of the population growth in our country and people moving into areas that are at risk for wildfire and building in these areas, or the wildfire areas have expanded, we now have a lot more homes and properties at risk for wildfire than we previously did. That, of course, is true for all these natural catastrophes. With development and growth becomes more risk for damage. So landslides are sort of one of the forgotten natural catastrophes. They're one of my own pet projects because I had a landslide in my own house 7 or 8 years ago. So they're kind of near and dear to my heart, not in a good way, but they do cause quite a bit of damage. Over $3 billion a year in damages from landslides. And this is a shot of Southern California, which I kind of commiserate with you folks because you're at ground zero for both wildfires and landslides. So along with your lovely weather that you have most of the year, you also have all these terrible natural catastrophes that occur periodically. So the problem when it comes to an insurance perspective is that landslides, floods, wildfires, they're becoming essentially uninsured in America. Absolutely true with respect to floods and landslides, becoming more true with respect to wildfires. California, as some of you probably know, just passed a law a year or so ago, essentially put a moratorium on insurers trying to abandon the state if their policyholders are in an area that's been impacted by a wildfire and an adjacent area code to wildfire. So that's a temporary stop to insurers leaving. But if they have their own way, they don't want to insure homes in California that are at risk for wildfires. So in 2018, for example, we had $33 billion in uninsured natural catastrophe losses. And the numbers are just going up. They exclude coverage under homeowners policies for floods and earth movements. That's why landslides aren't covered, floods aren't covered. So, of course, one answer is, why don't you buy a flood policy? Well, almost nobody does. So you see the number there, about 5 million of the 72 million homes have flood insurance. But almost all those homes are required to buy flood insurance. Not many people buy it voluntarily. Roughly 20% of the people who are in high-risk areas, meaning the 100-year floodplain areas, as according to the flood maps, about 20% of those people buy it voluntarily. So if they don't have a mortgage where they're required to have it with their insurance, with their mortgage, they don't buy it. If you're in an area that's not considered the 100-year floodplain, about 1% of the population of homeowners buy flood insurance. So it has a really low take-up rate. So what about landslides? Well, as I told you, it's one of my sort of pet projects. But the only people selling landslide insurance are surplus line insurers, primarily Lloyd's of London. You can't get much coverage for what you pay, $1,000 a year, and it's just covers the landslide, and sometimes it doesn't even cover your house. It's just personal property damage. So you know that surplus line insurers are essentially bare bones coverage. They don't have any insolvency guarantee from the state. They're essentially unregulated when it comes to the forms and the prices they charge. It's a different world than buying from an admitted insurer. And similar to the flood insurance program, no one buys it if they have a choice. Only about 1% of homeowners in the state of Washington buy landslide insurance, even though that's one of the primary states at risk for landslides. This kind of came to light a couple of years ago with the Osa landslide that some of you probably remember. almost all those homes were uninsured, didn't have landslide insurance, so many of them were facing bankruptcy. And that's the problem with all these natural catastrophes. If somebody gets hit by a natural catastrophe, whether it's a flood, a hurricane, wildfire, landslide, they're left with a piece of property that's basically unsaleable, but they still have a mortgage on it. And so either the government bails them out, or they get a handout from somebody, or they're in bankruptcy for most homeowners. So that's contrary to the whole purpose of insurance, which is supposed to provide a social safety net against these sort of catastrophic losses. So why won't insurers cover natural catastrophes? I'm not going to spend a whole lot of time talking about these. We can maybe cover this more in our Q&A session, but the first argument they make is that they're correlated risks. They're going to cause widespread catastrophic losses across the entire pool of insureds at the same time. Insurers can't predict that. They can't collect enough premiums for it. So they're basically just uninsured. They also make the adverse selection argument, which is that only people who are at risk for these sort of events are going to buy the insurance. And of course, they make the moral hazard argument, which is a favorite of academics like ourselves, which is the idea that if you make this insurance available, people are going to move into dangerous areas. They're not going to take risks to prevent their homes from being burned down or flooded. And so it just creates a situation where it's not an economically efficient outcome. So I'm not going to spend a whole lot of time going through why I think each of these arguments has got some holes in it. But on the correlated risk front, I think natural catastrophes are less correlated today than they used to be, in the sense that insurers are now global, worldwide. They're expanding the pool of insureds to much more geographically and risk-diverse pool of people. They have new risk transferring techniques that they didn't in the past, like catastrophe bonds. 30 years ago, before Hurricane Andrew, the Northridge earthquake, catastrophe bonds didn't exist. They do now. They've always had reinsurance. That's an easy way to spread the risk across a much wider pool of insurers. And they also now have sophisticated risk modeling that they didn't used to have. Now, there's a sort of a two-edged sword to that, because they use their sophisticated risk modeling to advocate for higher premiums when they go to get premium rate approvals. But at the same time, they use their lack of ability to risk model as a justification of why they won't insure natural catastrophes. So it's sort of a two-edged sword to what risk modeling. Adverse selection, the only thing I want to say about this right now is that I think it's a bigger problem if you're selling catastrophe insurance on a peril-by-peril basis. So if you're only selling flood insurance, for example, the risk of somebody buying flood insurance because they think their home's going to get flooded is much higher than if you bundle coverages together, so that they have it's not everybody trying to insure the same risk. Floods, hurricanes, wildfires. If everyone's insured under the same policy, they're not going to be an adverse selection problem. And since banks require you to have homeowners insurance, if you had bundled coverage for natural catastrophes, you'd have a much higher participation rate. So I gave you some of the numbers there. Roughly 70% would give you 50 million homes being insured, as opposed to the 5 million you have under the flood program. So I'm not going to go through all the moral hazard arguments. The couple I will mention is that people cannot control the weather. Natural catastrophes are coming to us now, as opposed to us coming to them. You can deal with it through building codes and ordinances, zoning restrictions. Yes, we don't want people to live in areas that are high risk, but they're already there. And so we have to deal with the people who are already there. Telling them they have to move is not going to be a good answer, because there's 100 million of these folks out there. That's not going to be the solution. So my normative proposal, as some of you have probably seen in some of my papers, is basically to try to bundle natural catastrophe insurance together in a federal program. You'd be able to spread the risk of loss across the entire country, as opposed to just sort of state-by-state geographic restricted areas. It addresses the adverse selection problem. It also increases the risk diversification of the pool. Frankly, trying to solve climate change is not going to solve the insurance problem, because even if we can get a worldwide agreement on how to deal with the collective action problem of climate change, it's still going to take decades after we become carbon neutral for climate change to reverse. So waiting for climate change answers is not going to solve the insurance problem. So as I said, I'd like to bundle everything together. It's what you do when you have market failure, which I think we're having with natural catastrophe coverage. You see, and I gave you some examples here of the Affordable Care Act, residual risk insurance programs for coastal areas and auto insurance. We've done this many times in the past. The difference would be we'd have the federal government taking the lead on it, as opposed to states. So the last point I'd make on this before I just wrap it up is to say that one advantage of trying to insure this stuff is that it would eliminate sort of the government bailouts. Right now, we have this sort of an ad hoc system where we have a natural catastrophe occur, and the federal government, through legislation, creates a pool of money to help people who've been victimized by these events. I'm all in favor of helping them. I just think it'd be easier to do it through a program where it's more transparent. We're ensuring that the people who are getting the benefits are actually paying into the program as well, as opposed to just taxpayers on an ad hoc basis after the fact. So climate change isn't going away anytime soon. It's increasing the severity and frequency of natural catastrophes. Homeowners need some coverage for these events because that's the primary risk they're facing today. Your risk of being hit by a natural catastrophe is much higher than having your houses burned down due to a bad electrical wire or something. Most developed countries across the world, I'll give you a handful of them here on my slide, insure natural catastrophes through government-sponsored programs, or they mandate private insurance cover it. And I listed New Zealand and France, and there's many others as well. We can look to those as models. We don't necessarily have to do the same thing as them, but they show that these programs are feasible. So with that, I'll turn it back to Anya. I appreciate your folks' attention.
Thank you so much. So next up, we have Dave Jones.
Great. I'm going to see if I can share my slides here. So thanks for the opportunity to talk a little bit about climate risk and insurance regulation, and hopefully folks can see that. And let me see if I can figure out how to advance it. Or not. There we go. So there's really two ways in which climate change manifests for insurers. One is physical risks, which just was described by Chris significantly, and then transition risks, which are essentially risks associated with transitioning away from an economy that relies on greenhouse gas emissions to one that is a low emissions economy. That poses the potential that certain assets in the economy in which insurers might be investing through securities like coal, oil, gas, or even auto manufacturers that are principally manufacturing gas combustion engine vehicles, that those investments will become stranded because their value declines as a result of an economic shift away from those particular industries. And these physical risks and transition risks impact insurers both on the underwriting side of their business, as we just heard from Chris, but also on their investing and reserving side. Recall that insurers collectively actually hold and reserve trillions of dollars in order to pay future claims, but they invest those resources, and there are risks both to the underwriting side as well as the investing side. Physical risk to the investing side could include potentially, say, investments in certain asset classes that themselves are physically impacted by climate change, and then there's the transition risk as well. So we just heard a moment ago what's happening in terms of physical risks in the U.S. This is a little chart from Swiss Re Institute that looks at global insured versus uninsured losses. The blue line, the dark blue line is insured losses, and you can see them climbing globally significantly over time. And we heard a little bit too about one of those perils that's driven by climate change, wildfire. In California alone in 2017, the wildfires coupled with a follow-on mudslide in Montecito cost insurers over $13 billion in losses. And in 2018, we had the most catastrophic wildfire in California history, at least in terms of lives lost and structures destroyed. That caused over $12 billion in insured losses for insurers, resulted in a small insurance company becoming insolvent due to fire claims, and then also drove our major Northern California utility into bankruptcy due to its liability for causing fires. So, as Chris just alluded to, I do think we are marching steadily toward an uninsurable future related to the physical risks that are being driven by climate change. We're just not doing enough fast enough to reduce greenhouse gas emissions globally, and we already have a fair bit of climate change baked into the system, as Chris pointed out to. And when the risk gets too high, private insurers exit the market. So we're seeing that with regard to home insurance renewals in California's wildland urban interface, as insurers decline to renew insurance. As Chris pointed out, we've seen that with regard to flood risk in the United States, where home insurers stop writing flood insurance. And for a non-climate related peril, earthquake, we saw that with regard to earthquake risk in California after the 1994 Northridge earthquake, where insurers just said, that's it, we're not going to write this insurance any longer. So just another word about transition risk to insurers' investments, and just taking a look at fossil fuel investments as an example. The impact on investments from climate change can come through several channels. One is market forces. So in this particular case, we've seen a decline in prices per kilowatt hour for renewable energy, and it's competing better against certain fossil fuel energy sources. We see regulatory measures at the local, state, and national levels reducing the ability to use fossil fuels. We see technology changes that are driving the transition as well. So thermal coal, for example, as an investment class, saw a dramatic decline in its value. The Dow Jones U.S. coal indices dropped dramatically. We saw major institutional investors like CalPERS and CalSTRS lose $840 million in coal investments, large number of U.S. coal companies going bankrupt, and global insurers, as a result, are divesting from coal, and banks are declining to lend to coal. So thermal coal is an investment class, not such a great investment for an insurance company or for anybody else. So what are insurance regulators doing about this? In 2009, the National Association of Insurance Commissioners adopted a climate risk disclosure survey. The problem was, after the NAIC adopted it, states didn't implement it. So in 2011, when I came into office, I recruited 4 other states to begin implementing the climate risk disclosure survey annually, and collectively we're able to reach about 75% of the market. It asks qualitative questions of insurers with regard to how they're addressing climate risks in their underwriting, investing, and operations. And then we publish those results to make them available to other regulators and the public and other insurers to see how each is doing addressing these risks. The problem is it's qualitative questions, so it doesn't really collect the kind of quantitative information a regulator needs, or an insurer should be collecting for that matter, to understand these risks. But one takeaway from this survey was that insurers were just not considering transition risks to their investment portfolio. So that led me in 2016 to launch a climate risk carbon initiative. I reached the conclusion that transition risk posed financial risks to investments insurers held in oil, gas, coal, and utilities. My objective was to get insurers to consider those risks and also to improve our understanding of what the risks were to investments in oil, gas, coal, and utilities vis-a-vis exposure to transition risk. So that initiative involved requiring over 670 insurers in the U.S. to disclose their investments in oil, gas, and coal, and utilities. We made that information available in a public and searchable database so that the public, as well as other regulators, could look to see what each insurance company was holding in terms of those assets. I also concluded that thermal coal as an investment class was facing a significantly high potential of being a stranded asset. So I asked the 1,300 insurance companies I regulated to divest from thermal coal and to pledge to refrain from future thermal coal investments. That was a voluntary request, but we did say we would publicly disclose how they responded. So the results were that of the about $5 trillion in assets held by insurance companies in the U.S., they had about $555 billion in fossil fuel-related investments, $21.4 billion invested in thermal coal enterprises. We were able to secure about $4 billion in thermal coal and fossil fuel divestments from these companies, an additional forward commitment of $944 million in divestment. Some 670 insurers either divested some or said they didn't have any coal holdings, and 325 said they would refrain from future coal investment. So just an example of the way in which regulatory action, even voluntary action in the case of asking for divestment from coal, can have a significant impact on insurance company behavior. We put the results in a user-friendly database so folks could take a look at that information by insurance company. At the same time, the G20 Financial Stability Board, concerned about the systemic risk to climate change was posing to the global financial system, set up a task force on climate-related financial disclosures led by the private sector. It issued a report in 2017, which was a framework for corporates and financial institutions, including insurance companies, to assess and report climate-related risks and the risk management strategies. One of the seminal recommendations, though, was that investors, including insurers as investors, should undertake climate risk scenario analysis of their portfolios. That is, run different climate risk scenarios with regard to climate change against their investment portfolios and see how those investment portfolios performed and how aligned or misaligned those investment portfolios were with different climate change scenarios. So I took up that recommendation in 2018. I used a model that the 2 Degrees Investing Initiative, a global think tank, had put together that could enable me to analyze the investment portfolios of over 670 insurers holding $4.25 trillion in assets. And we looked at the alignment of their investment portfolios with different climate scenarios, and looked at the alignment or misalignment of their portfolios with what the economy needs to look like in order to keep a global temperature rise below 1.5 or 2 degrees. We also looked at, in the last iteration of that in 2019, physical impacts to investments that insurance companies were holding. So what were the results of that? Very quickly, we found that insurance company investments in thermal coal were very misaligned with keeping temperature below 2 degrees. Their investments in the automobile sector and oil production sectors were also misaligned. Gas production, not so much. And they were considerably underinvesting in renewable energy. So this gave us some insights as a regulator with regard to if there were an abrupt transition as a result of, say, significant policy change with regard to the ability to for industries to emit greenhouse gases, that could have implications for insurance company investments in each of these sectors in which they were misaligned, and potentially as a regulator provide some information with regard to what we should be encouraging insurance companies to do with regard to trying to address that transition risk. The UN put out a study in 2019 that looked at risks globally with regard to climate change in the financial sector, concluded that there was a risk of loss of 13.6% of portfolio value, a value loss of $10.7 trillion globally, and opportunities, though, on the plus side, if investors, including insurance companies, are investing in ways that support a transition, but certainly greater risk and loss if governments delay action and take action at the end. I'm going to just move quickly in the interest of time, but there has been some insurance sector leadership in this space. Some number of companies have committed, global companies, to stop investing in coal, to stop underwriting coal. There's a net zero assets owners coalition that includes leadership from insurance companies that have agreed to realign their investment portfolios by 2015 so that they're emitting net zero emissions. Some insurance companies have committed to decarbonizing their underwriting. And then, as I think we'll hear a little later from one of my colleagues, there are insurance companies that are leading with regard to designing insurance products that are aligned with nature-based solutions to climate change and climate risk. So outside the United States, there has been a substantial amount of activity by financial regulators, including insurance supervisors, to address climate risk. Leading financial regulators, including central banks and insurance supervisors in Europe and Asia, have concluded that climate change poses systemic financial risks to the financial system. They have stood up consortia to address those risks, including the Network for Greening the Financial System, which is a consortium of central banks that are putting together best practices to address financial risks to banks. In 2016, I formed the Sustainable Insurance Forum, which is a global network of insurance regulators to develop best practices to address climate risk to insurance companies. But the principal approaches are disclosure, climate risk scenario analysis, and then climate risk stress testing. And stress testing builds on essentially practices that the Federal Reserve and other central banks undertook in the wake of the 2007-2008 financial crisis. And the idea is to look at both the insurer's underwriting portfolio as well as their investment portfolios and stress those portfolios against different climate change related scenarios, both in terms of losses on the underwriting side, but also potential losses to their investment portfolios, and see how the balance sheets perform. And then that gives insurance companies and regulators some better understanding of what insurers ought to be doing to make sure that they can withstand those sorts of stresses. Unfortunately, U.S. financial regulators, whether it's the Fed, the SEC, the Office of the Comptroller of Currency, the list goes on, are largely AWOL, as are state insurance regulators. I think with two notable exceptions, the California Insurance Commissioner initiatives that I described a moment ago, and then the New York Insurance Superintendent has importantly joined the Network for Greening the Financial System, joined the Sustainable Insurance Forum, and also announced importantly just this last year formally to insurers that her expectation, Linda Lacewell, is that insurers will begin to address climate risk, and she's beginning to launch some initiatives to make sure that they do that. So just in close, there's really a critical need for state insurance regulators to act on climate risks. As Chris alluded to, state insurance regulation in the U.S. is done at the state level. So we need insurance regulators to take up these best practices. There was a seminal report issued last year by the Commodities Future Trading Commission that looked across the entire U.S. financial system and looked across all U.S. financial regulators and concluded for the first time that climate risk pose a stability risk to U.S. financial system. That's the first time a U.S. financial regulator has reached that conclusion, had recommendations for all U.S. financial regulators as to what they ought to do, but also had recommendations for state insurance regulators to require disclosure of climate risk by insurers using the TCFD reporting framework to undertake climate risk scenario analysis and undertake climate risk stress testing. And the time to act is now. We really can't wait for this to occur. The other component of things financial regulators, including insurance regulators, ought to be thinking about is adjusting the capital requirements that they impose on insurance companies to hold reserves sufficient to meet future claims and adjust those requirements based on the climate risk facing investments. So quite a bit going on. Happy to take questions later on and really appreciate the chance to share with the audience a little bit about what is happening and what should be happening in the space of insurance regulation and climate risks. Thanks.
Great, thank you so much. So next up, we have Dr. Carolyn Kowski.
Great, thank you. And it's so wonderful to be a part of this panel and the conversation today. Let me similarly try to share my slides. Make sure this is working. Okay, does that look good? Okay, I see you nodding, so great, thanks. Hello everyone. I'm gonna build on what my colleagues have just talked about, and in my few minutes, I wanted to really address two questions. I wanted to talk about which should be sort of foundational to this panel, why we're all here, but just sort of say explicitly why disaster insurance is so important to climate resilience and why it really needs to be a part of the policy conversation when we're talking about building climate adaptation and climate resilience in the face of escalating extremes, which Chris so nicely laid out for everyone. And then in the second half of my quick remarks here, I want to talk about how we can innovate on insurance to help better meet our climate resilience goals in the face of those stresses to insurance markets that, again, both Chris and Dave had mentioned. And so are there ways that we can think a little bit differently about risk transfer to try to meet some of our goals? So let me jump right into the first. Let me move these people. There we go. Okay, sorry. I had too many videos going on there. So let me start why I think disaster insurance is such an important part of the climate resilience conversation. And it's really simple. It's because there's now a robust body of research that people with insurance recover better and faster than those without insurance. And this is really because there's no substitute to having the resources needed to rebuild and replace damaged and destroyed property than insurance. So we could talk more about this, but the majority of households in the US do not have enough liquid savings to recover from a severe disaster event on their own out of what they have in the bank. Disaster aid from the federal government is wildly insufficient and often really delayed, often contrary to some misperceptions on that. While loans can be really helpful and often are a good source of recovery for middle and upper income families, those that need help the most are often locked out of access to credit. And so work by a colleague has found that over half of applicants to the SBA disaster loan program, for example, are rejected because they don't meet basic debt to income and credit score requirements. So of course, some of the folks who need it the most, credit isn't a panacea. So if you don't have money in the bank and disaster aid isn't going to cut it and you can't get access to credit, then what? And that's when insurance comes in and why insurance is so important. And we'll come back to this, but of course it's also the case, right, that the families, you can see from thinking through this logic, that need insurance the most are often those that are least able to afford it. So we also need some policy solutions there as well. But beyond just insurance being so critical to being able to financially recover from a disaster, there's now a growing body of research too that having that financial resilience, that ability to recover financially, is actually foundational to all sorts of other recovery post-disaster. And that's because if you don't have the money in order to rebuild and get back into a safe home after a disaster event. That's been shown to lead to all sorts of negative mental health impacts, stress, and anxiety. And also, if you don't have the funds to make your home safe again, then you have to divert funds from other important sources, right? So you might have to be diverting funds from health or education or other important things. And that, of course, then has negative welfare impacts for families as well. So financial resilience turns out to be important for all these other non-financial reasons as well. And then beyond just the household, there's also now, again, these are smaller literatures, but a growing body of research that as insurance is more widespread in a community, so as more households and businesses actually have disaster insurance, that the disasters then have a less negative impact on things like macroeconomic indicators. Recovery happens sooner in the community. There's some international evidence that credit ratings don't suffer as much. And so in this way, insurance actually becomes important at a community level as well. I do want to highlight that this is a growing area of research and one where I think some more studies are needed. For example, we don't know as much about how increasing insurance penetration in a community does things like maybe reduce the burden on municipal services or lessen out migration or increase post-disaster tax revenue. So this is an area, if there's any doctoral students listening and they want to know where to focus their dissertation, where I think some more work could be done. Okay, so this is all just to say that insurance is so critical, right? And yet, as insurance is going to become ever more important because of the escalating disaster losses that Chris talked about in the beginning, those same escalating losses from climate are also stressing the insurance market, as we've heard talked about a little bit already, right? And that's because insurance and other forms of risk transfer often rely on concepts of risk pooling, which work really well for independent and non-catastrophic risks. But of course, and this is a challenge even before you put climate into the picture. Natural disasters, everyone is impacted simultaneously, right? And so because of that, in order to effectively insure disasters, insurers have to have access to a large amount of capital to not go bankrupt in the face of one of these. And, buying or renting capital is not cheap. So disaster insurance is often much more expensive than other lines, which can make it more than people are willing or able to afford. And so that has led to all these sorts of interventions in disaster insurance markets, which was also alluded to, right? In fact, there's nowhere in the world today where there is a fully private disaster insurance market with a high degree of take-up rate. So you need these kind of public interventions. And around the world, they've taken a wide variety of forms. And we could talk more about the structure of these different types of public-private partnerships. But what I wanted to make the point right now is just that while climate is stressing private insurance markets, it's also going to stress the public programs, right? They're not going to be immune from the kind of growing losses too. So while we've seen challenges in the private market, it was mentioned the difficulties in the California homeowners market after the severe wildfire seasons in 2017 and 28. It's also the case that our public programs are going to start to see problems, right? So now the California Fair Plan's holding a lot of wildfire risk. In places in the South and East where nuisance flooding is becoming increasingly common, in a few years, there's going to be areas where flooding is not a risk anymore, it's a certainty, right? And so you get these uninsurable areas that are going to impact our flood insurance program and so on. Okay, so in the face of these challenges and the fact that we need insurance for all the recovery reasons we talked about at the beginning, what are some different things we can do? And so what I wanted to do is spend a little bit of time talking now in my last few minutes about some ongoing projects at the center that are looking at ways we could maybe innovate on standard insurance and standard approaches to risk transfer to help ensure that everyone can have sort of equitable access to the resources they need to recover post-disaster. And as Dave mentioned, maybe also harness it for things like protecting ecosystems and other goals as well. So just two sort of background points before jumping into, I'm going to talk about 3 quick innovations today. But first, I just want to note that insurance, while we spend a lot of time talking about sort of standard property insurance, so at the level of the household or the level of the business, insurance can be written and is written at all scales, from microinsurance, which I'll talk about, all the way up to governments making use of risk transfer, right? Like Mexico purchases catastrophe bonds, and there's sovereign risk pools around the world and so forth. So there's really lots of opportunities to harness risk transfer arrangements for disaster recovery. And then the other distinction I just want to make sure everyone's clear on before getting into the couple of solutions is the difference between indemnity and parametric insurance. So most insurance that consumers are most familiar with in the United States is indemnity insurance, which just means that your payout is directly related to the damage, right? So if you have a homeowner's policy and a tree falls on your roof, an actual loss adjuster, a person, comes to your house and assesses the damage and determines how much you should be paid in order to repair only that damage from that event, right? That's in contrast to parametric insurance, where the payout's related to some independent observable measure of the hazard. So for example, if it was a hurricane parametric product, maybe it would be that you'd get a set amount of money whenever a Cat 4 or 5 storm passed within so many miles of your primary residence. That would all be sort of laid out in the contract. And you can see, there's some benefits and costs associated with a parametric policy. So one of the great things about them is that you can get payouts really fast because there's just some observable measure that doesn't require sending loss adjusters out into the field, and there's not a lot of negotiation about what the number should be or dispute, right? So payout can be often in a matter of days, and so it's a lot faster. And there's a lot of flexibility in the money. So it's also really useful because you can use the funds for whatever types of unexpected expenses might come up after a disaster. But of course, you can also see that because your payout could be more or less than your actual damage, it is not at all a replacement for like a standard homeowner's insurance policy where you really do need to be sure that you're going to get covered for the disaster damages. Okay, so with that as background, now the first thing I wanted to talk about was the concept of microinsurance, parametric microinsurance. So microinsurance are policies that have low premiums, but also lower coverage limits and are designed to target poor populations to provide populations with insurance that usually aren't part of the kind of private insurance market. Microinsurance has been used around the world now, usually in developing countries, providing coverage for a wide variety of risks, health, life, crop, livestock. And a project right now at the center is focused on whether we can take lessons from those applications and actually use microinsurance in a US context where it has not been used to date to help protect lower income households in the United States from sliding further into poverty as a result of having insufficient resources for disaster recovery. And of course, this is a parametric product because it's very costly and time consuming to adjust losses, particularly if they're low premium, low coverage policies. It's just not cost effective. So in order to be able to even think about writing this type of sort of low premium, low coverage policy, it tends to have to be parametric. So I said this hasn't really been used in the US to date yet, but Puerto Rico is the one place that's starting to explore it. This past summer, they passed regulations that would allow a catastrophe microinsurance market, but to date, no policies have yet been written, but they're hoping to jumpstart a market there. And in our work, we've been looking at different ways that you could deliver microinsurance because the sort of delivery channels have taken, a wide variety of forms, and we're trying to think through what might work in a U.S. context. So I won't get into the details here, but for example, in some models, there's an NGO or local government that might be the one purchasing the insurance, and then they disperse it to the individual populations that are impacted after a disaster. There's a lot of mobile models now, right, where you can just buy the policy on your phone, and then either, the money goes directly into your bank account, or you can also link it to mobile money platforms so that you can use it even for the unbanked. And in the US, over 70% of adults making less than $30,000 a year still have a smartphone. So this might be a way to help there. We're also looking at whether public sector programs like the NFIP or state wind pools might offer microinsurance, whether you can make use of public sector captives. And then finally, the last thing we're exploring is whether you might tie microinsurance policies to other products, like to a lease or to your utility bill, and then sort of cost share in the premium as well. Okay, so that's one model, which is trying to get at how do we help these lower income households with recovery when they can't really afford insurance right now, and our aid programs really aren't means tested enough and not giving them the support they need. So maybe microinsurance is one option to help better meet the needs of that population. The second innovation that we've been looking at, and this is in collaboration with MMC and Guy Carpenter, is what we're calling community-based catastrophe insurance. And the idea here is that a local government or a quasi-governmental body would purchase insurance on behalf of a bunch of properties within their jurisdiction. So maybe this is like a special purpose district that buys coverage for the households or even small businesses within their jurisdiction. And the idea here is that a community-based policy could really help close the disaster insurance gap because, as said, most people don't have coverage for a lot of climate-related perils. Well, not only climate, there's very low uptake of earthquake too, right? And this could help do that. It could provide a base level of coverage for disasters. It could fill in other sorts of holes. There's a lot of flexibility in how you design this and a lot of different models. And so a report that we have on this that's coming out next month is looking at these different ways that you could administer a community policy and what the implications are for the sort of roles and responsibilities of different parties. So you could have the local government that's really just a facilitator, kind of linking households to the insurer, all the way to the community actually purchasing the policy. And there's, again, different ways to do that. But some of these models might generate more cost savings on disaster insurance than you'd find right now in the private market. And they can also link better to community investments and hazard mitigation, which is something appealing as well. And I'm going to pick this theme up in a second. But right now, it's really hard to harness individual premium reductions across a lot of policies to finance community level investments and mitigation. Okay, so in the last couple minutes here, the very last one I wanted to talk about, and which Dave started to mention, is this concept of insuring nature. And he could say more in Q&A to folks, but as he was part of this really kind of innovative pilot to insure a coral reef off the coast of Mexico. And that program that got set up has inspired a lot of thinking about whether we can harness insurance to provide more funding, more financing, more incentives for conservation and restoration when those natural systems are also reducing disaster risks. And so a colleague and I at Wharton took a look at what the difficulties would be in sort of scaling up this type of policy. And unfortunately, there are some challenges in getting more widespread use of such a tool. But just really quickly, there's basically two ways that you could harness insurance to be thinking about conservation and restoration. The first is what I just mentioned, which is actually thinking about the natural asset, the natural system as an asset itself, like property, and taking out insurance on that system or that asset. And the second one would be you're still insuring property, but you want to just reflect the protective value that different ecosystems might be providing. So the challenge with the first one, that's the sort of Mexico example, is that, you know, in a sort of cursory look we did, there's only limited circumstances where both the financial and the ecological aspects of a system is going to make insurance worthwhile. And that's because, first of all, if you're insuring the asset, right, insurance is paying money. You have to pay your premium every year in order to get a large payout when damage occurs. And so when that would make sense for insuring a natural asset is when there's potential damage to a system that you then need a lot of funding to go in and help fix. So after lots of natural disasters, it's sometimes best just to leave the system alone and let it heal on its own. And then it doesn't make sense to insure it, right? It also won't make sense to insure it if the restoration activities post-disaster are sort of low cost and better able to be paid out of just, you know, general year-to-year operating revenue, because then it's not cost effective to be paying this premium all the time, right? But so times when you do need a lot of funding to go in and help do that restoration is when it would make the most sense. And the second challenge, though, is that you still have this kind of basic public goods free rider problem, right? Where these are systems that are providing benefits to a whole group simultaneously, and you want everyone to contribute to those premiums as needed. And so I think one of the actually most innovative things about the Mexico example that I think isn't highlighted as much is setting up the institution that brought together all these different stakeholders to collectively manage the coral reef in the first place. And maybe Dave could say more about that if anyone's interested. Okay, then the second one, the idea of insuring property, you know, right now, if there are large natural systems providing protection, you know, that would be incorporated in a lot of the modeling and pricing. And I think the question is really, you know, if we're going to invest new in restoration or conservation of a system, is there a way to then harness those premium reductions from that benefit in order to help finance that investment in the first place? And that's a little bit tricky because, again, it comes to this institutional question where, say you want to conserve a bunch of wetlands to provide flood protection, and there's hundreds of properties being protected by it. You have to have some institutional mechanism to pull off the little reduction in premium across all these hundreds of properties, right? And so maybe that's a tax, maybe it's a fee, maybe it's something else, but you have to set that up along with it. And then there's also some challenges just right now with translating investments in nature into actual pricing of policies in a way that the insurance sector feels comfortable with. Okay, I'm well over my time, so I'll kind of wrap it up there. The very last thing I just wanted to say is that while I do think it's really important that we continue to think about how insurance is a part of the climate adaptation conversation and how we can kind of innovate in this space, where we're really going to need to re-envision, in my mind, is how we extract value from high-risk areas, be it the coast, like here, and this is what I think of as one of the most climate resilient communities in Florida, or wildfire-prone areas, inland flood areas, areas to make sure that we protect ecosystems, keep people safe, allow for equitable recovery, and enjoy the benefits these areas have to offer. Okay, I'll stop now. Thank you.
Great. Thank you so much. And we'll wrap it up with Professor Lemon.
Hi, everybody. Thank you all so much for being here on a Saturday morning. I'm going to focus on flood risk in particular, and on one of what I think is one of the most commonly talked about ways of using insurance systems to increase our resilience against climate change risks, which is combating the moral hazard that's associated with the National Flood Insurance Program. The National Flood Insurance Program, as you all probably know, has been a target for climate change motivated policy reform for, I think it's safe to say, decades now. Climate change is obviously increasing our risk of flooding in a variety of ways that Chris reviewed very nicely for us. One number that always sticks out to me that I think is maybe worth mentioning again is the idea that by the end of the century, which at this point is less than 80 years away, roughly $1 trillion of real estate in the United States alone will be literally underwater, which is usually defined as more than 25 days of flooding every single year. So this is a huge glaring problem. There's no doubt that it's coming. And to many observers, the National Flood Insurance Program is part of the problem rather than part of the solution, or at least it has been up to this point. And that's because the National Flood Insurance Program arguably creates a moral hazard by making it more appealing for people to settle in these high-risk areas, cushioning the financial blow that they experience when they have a flood. So the most commonly proposed reform is we need to change the rate structure of the National Flood Insurance Program so that people pay actuarial rates, meaning rates that reflect the actual risk that their own individual property faces. The idea there is if people are required to bear this cost, it would make them think twice about moving to a flood-prone area. And another background fact that maybe you all are already aware of is that the share of the U.S. population that lives in coastal counties has just been growing inexorably over the course of the last 50 years. So we've made basically no progress. I think it maybe even is right to say literally no progress in moving people away from flood-prone areas, despite some isolated examples here and there. I think there are reasons to be skeptical of this argument, and there are reasons that I think are nice. They fit well with this panel because we've heard some echoes of some of the themes that I'm going to talk about from some of the previous presentations. And the basic concern that I have is that we have in our political culture and our legal culture a kind of deep anti-paternalist strain. And this is reflected in the idea that people have, the just gut reaction that you can't tell me where to live. This has been a problem with enacting these reforms over the past few decades. And I think it's a problem that people who would like to see more actuarial rates in the National Flood Insurance Program have not yet sufficiently grappled with. So I think this is part of the reason why it has been so hard to enact reform for the National Flood Insurance Program. Many of you may know that the last time Congress tried to significantly change the way rates are structured in the NFIP was in 2014, and it lasted for less than 2 years before they significantly repealed all the reforms that they had enacted because there was such an overwhelming popular groundswell of opposition to these changes that came from all different parts of the country and all different political parties. So my thesis that I just want to sort of present to you all is that there are a few problems with this sort of paternalistic idea that we need to force people to buy flood insurance that is priced at actuarial levels. One problem is the elusiveness of a purely rational solution, and I put that in quotes, to the problem of flood risk. And another problem is that a paternalistic solution to this problem raises distributive concerns that I think people have been insufficiently attentive to. Okay, so some people sort of start with an instinctive reaction to this suggestion by saying that, this isn't really an issue of paternalism because the risk of flooding is socialized, right? So we all as taxpayers help pay for the risk of flooding that people in coastal areas and in areas close to rivers all over the country experience in a whole range of ways. And so some people think that if the risk of flooding is socialized, then the government should be perfectly able to regulate the extent to which people expose themselves to flooding in whatever way they choose to. And that might include making areas off limits to rebuilding in the wake of a storm. It might include adaptation measures like being required to elevate your home above base flood level, which is part of the National Flood Insurance Program. I don't think that argument really works. In other words, just because the government has elected to take on some of that risk by, for example, passing significant aid packages in the wake of major storms, doesn't give it the right to tell people where they can and can't live. And, for evidence, you can look to the way people have reacted to these moves in the past. As Chris pointed out very rightly and helpfully, I think, there's this sort of attitude in the popular press and even among some academics that flood risk is largely a rich people's problem. And there's this image in people's minds of the gigantic beachfront mansion in Florida or in the Gulf Coast of Alabama or somewhere like that just gets flooded again and again. But the data is increasingly showing that, especially outside of Florida, which is sort of an outlier among states, it is low-income people and communities of color are disproportionately likely to live in areas that are at high risk of flooding. And as Carolyn pointed out, they are also disproportionately likely to experience the most extreme version of the harms associated with flooding because they lack the financial resources to cushion the blow that any hurricane or other flood might bring. Just to pick a familiar example, as Hurricane Katrina was approaching New Orleans, there was a mandatory evacuation order issued, but roughly 100,000 people in the city of New Orleans do not own a car and had no way of evacuating, and no other way was provided. So if you own a car, you can heed the evacuation order and leave the city. If you don't, you're out of luck. So there's an enormous problem here. And yet, in the wake of the storm, when the government wanted to make certain neighborhoods off limits for rebuilding because of the high risk those neighborhoods faced, there was enormous opposition from people whose feeling was, you don't have any right to tell me that I can't rebuild my home. Okay, so why is that? I think there's a set of problems that go into the category of values that people haven't been paying enough attention to. So one problem is incommensurability. It seems very obvious from a sort of 35,000 foot perspective that there are many parts of the country that just don't make any sense to inhabit anymore. But that problem is harder to pin down when you think about how do we weigh the costs associated with flooding against the benefits that people derive from living in any given flood-prone neighborhood. The costs are expressed in dollars, and that's very easy. But the benefits of living in a neighborhood that has been your home for, in some cases, generations, are hard to translate into dollars and cents. And in some cases, that is, it's so difficult that it's not even really worth trying. This problem comes up, I think, most clearly when you see policy discussion of what FEMA calls repetitive loss properties, which is a subset of properties within the National Flood Insurance Program that have experienced losses of more than more than one loss of more than $1,000 within the past decade. And you frequently see in the press reports that, a house whose market value is, say, $80,000 has received more than that amount in payouts under the National Flood Insurance Program in the past decade. And the sort of instinctive reaction that people have is that doesn't make any sense. Why are we paying this money to rebuild a house that's only worth $80,000? Well, the problem is that the market value of a home doesn't necessarily reflect all of the value that it might have for the people who live there. And that's something that matters a lot to those people who are going to be the subject of any regulation that we might enact. Another big problem is the subjectivity of the values involved, and this is related to the last problem. How much is my home or my neighborhood or even my city worth to me? There is not one objective answer to that question. Some people might be perfectly happy to move to a drier home. Other people place an extremely high subjective value on their neighborhood and so are resistant to the idea that they should be forced to leave. There are all these examples of places that are currently grappling with this question of retreat, where they have an extremely high subjective value on their homes, and that makes it more difficult than you might expect from a kind of objective policy perspective, right? So one famous example is the community of Ile de Jean Charles, which is a Native American community in rural Louisiana that in the past few years has elected to move itself inland and attracted a lot of media attention for doing that. And it seems like a very obvious thing to do because the community is just a tiny sliver of land at this point. It has lost more than 90% of its land, and it is one of these places that is going to be underwater in a matter of decades. And yet, the votes that they have taken to make this decision about whether to move have been extremely close, and there is still a significant portion of the community that has elected not to move and that has decided to stay. And there's a fantastic book that I recommend to everyone by a writer named Elizabeth Rush. The book is called Rising, and she writes very affectingly of the extremely difficult emotional calculus that people have to go through when they're trying to decide whether to abandon their homes, even in the face of seemingly very obvious risk. Final problem is the problem of uncertainty. Here's one where I think, again, from a very sort of distant policy perspective, it seems extremely obvious that there are coastal areas that are going to be underwater by 2100, and it does not make any sense to continue inhabiting those areas. But the science of climate change is one that doesn't translate extremely well into making super specific estimates of risk in shorter time horizons as to one particular property. And this is part of the reason that the risk is so hard to price, as Chris has already mentioned. We know that climate change is already happening, and that so far the world has not made much progress in reducing global emissions, and that will translate into a certain amount of increase in mean global sea levels. But exactly how much of an increase is a matter of significant uncertainty. It could be as little as a foot. It could be as much as 8 feet. And how does that affect any given neighborhood is also hard to say, because there are complex geological processes still unfolding, ocean currents that are changing. There are some parts of even America that are experiencing above average sea level rise. Some parts are experiencing below average sea level rise. And so it's very hard to take that global data and translate it into an answer that you can provide to one individual homeowner. And this is why FEMA has so far, one part of the reason that FEMA has so far been unable to incorporate any of this forward-looking data into its risk pricing in the National Flood Insurance Program, which is based exclusively on backwards-looking data. So this uncertainty is something people are working on, but it makes it hard to say to any individual homeowner, you should be leaving. And it makes it hard to feel confident in the price that we are putting on the flood insurance premiums that we're requiring them to pay. Then finally, and I think perhaps most significantly, there are distributive concerns that we need to be aware of. And this also has been echoed by Chris and Carolyn already. anti-paternalists in our sort of legal history, closely associated with a laissez-faire sort of political philosophy, that the philosophy creates significant distributive concerns that we are all, I think, well aware of. If you want to say that everyone should have the freedom to work 16 hours a day in a bakery, well, the people who are going to make that choice are the people who don't have other choices, right? That's the lesson of Lochner. We've moved away from that attitude, I think it's safe to say. But moving too far in the other direction creates its own distributive concerns, especially when you keep in mind the background facts that Chris and Carolyn have both mentioned, that flood-prone areas are disproportionately inhabited by low-income people and communities of color. So if you say that those people are forced to pay risk-rated flood insurance premiums or simply to move, well, now you're singling out for an extra burden, a tax, low-income people, right? So I think it's fair to think of risk-rated flood insurance premiums that are mandatory as kind of like a cigarette tax for flood-prone homes. Cigarette taxes, the goal is to get you to stop smoking cigarettes. But of course, it's poor people are more likely to smoke cigarettes than rich people. And so the effect is that the tax is highly regressive. And I fear that we would be moving in that same direction if we forced everyone to pay risk-rated flood insurance premiums. I don't think that means we can't do anything. I think I'm running low on time, so I'm going to wrap up. I think what we need to focus on, perhaps more than we have in the past, is empowering people to choose to leave themselves. And that means strengthening buyout programs that currently are too patchy and hard to navigate, and also making it more obvious to people when they are at risk. So better disclosure of the flood risk, in addition to the wonderful ideas that we already heard from Carolyn. So with that, I'll close, and thank you all so much for this panel.
So thank you so much, everybody, for coming together. And we just have a few minutes for discussion, which I know will be way too short. So I hope that you all reach out to some of the speakers and read all of their great research. I'm going to try to put together two questions. One from Kenneth Klein, which is basically, given the state-based regulation and NAIC's commitment to state-based regulation, what is the chance of any federal government actually passing legislation in this area, as Chris was mentioning, coupled with Dan Schwartz's question, which is, there's been a lot of interest in state regulation, but beyond voluntary initiatives that Dave talked about, do state regulators currently have power to enact some of these changes? So maybe putting those together, it's how are we ever going to solve these problems? But would love to hear your thoughts. So I'll open it up to the panelists. Yeah, Dave, great.
So first, state insurance regulators do have the authority to mandate climate risk disclosure, to undertake climate risk scenario analysis, and to undertake climate risk stress testing in their existing state statutory authority. So although one aspect of what I did was a voluntary request, that was the request that insurance companies divest from thermal coal, the other best practices, if you will, that have emerged internationally and that are also included in the CFTC report are all things that are within the scope of insurance regulators' existing authority. And so they should use their existing authority to mandate disclosure consistent with TCFD reporting. They should undertake climate risk stress testing. They should undertake climate risk scenario analysis, and they have the authority to do it. We don't need new laws to do that. I guess the concern I have as it relates to standing up a national catastrophe insurance program is that the federal government has the ability to print money and states don't. And the history of standing up government programs for insurance is I think best illustrated by the National Flood Insurance Program, where we end up with a program that is not rated actuarially, as Alex and others have alluded to, and where there's huge taxpayer subsidies. And I think we're sending the wrong price signal. The way to address the problem that Alex critically identifies, which is the distributional issues with regard to risk set rates for poor people is to draw a lesson from the Affordable Care Act. And so the Affordable Care Act has health insurance rates set based on actuarial rate setting, but there's a premium subsidy for poor people and poor families. So they're paying the actuarially set rate, but what they're actually paying is less than that because they got a premium subsidy. So you could do a similar thing either for a national catastrophe program or for a flood insurance program where you continue to have rates set based on risk, which I think is critically important to send price signals to the market about whether it makes sense for people to live in or continue to move in these areas, but then have a premium subsidy for poor people. But I do worry about additional national programs because the proclivity of Congress and the public behind Congress is to say, look, middle-class people and wealthier people, we don't want to pay these risk set rates. We want a subsidy. You can't really do that at the state level because state budgets have to balance. And so the California Fair Plan, for example, which is the fire insurer of last resort, sets rates actuarially. And it's actually a consortium of all the private writers of insurance and has the ability to surcharge private writers of insurance who are making money, by the way, on the 3/4 of the home that are outside the wildfire risk area. It has the ability to surcharge them in the event that it has insufficient proceeds to pay claims. So my own view is I think that's a better construct because I worry about the proclivity for national programs to end up being big subsidizers, rates not being set appropriately, and then wrong price signals being set. But I would anticipate there'll be great disagreement on the panel.
So I have a few comments on that too, if I can go next.
Yeah.
So I guess I would also kind of fold into this Peter Molk's comment as well that kind of tied into him trying to respond to Dan on the chat window. But so I think on the first question, is this feasible at the federal level? A week ago, I would have said no, it's not politically. With the Georgia election now, with the Senate though, a shot that it didn't have certainly in the last 4 years, and now I think in the last week it may have a chance. So I think there's a possibility on the federal level that there wasn't there previously. But as far as the regulators, there's something we can do at the state regulation level. And this is where I think Peter's comment kind of ties into Dan's question, is that if you did mandate this coverage under private homeowners policies, for example, for floods and wildfires and hurricane damage, landslides, all those sort of things, at that point, the insured would have an incentive to regulate policyholders' behavior. And I think the states would be in a much stronger position to help them do that, either through their own regulations or just insurers' self-interest in trying to regulate policyholders' behavior. So if you went with Peter's approach of mandating the coverages, then you could leave the regulation to state level, because then insurers and state regulators would have aligned interest because it's now under the state jurisdiction. But I do think it's still possible to do it at the federal level now with the change in Congress.
Great. Carolyn or Alex, we have 3 minutes left. So any thoughts?
I'll throw in my 2 cents. I agree with a lot of what's been said. I think that it makes a lot of sense from the consumer perspective to have your homeowner's policy cover the full suite of disaster risks, right? That makes things easier and it helps with financial resilience. The private sector can't offer that right now. There's too much of a bankruptcy risk and the cost would exceed what people can pay for most people, right? So what's been done in a number of other countries, and which I think is an actually pretty nice model, is to sort of directly address the market failure and put the public sector intervening where the public sector is best, which I think is cutting off the tail of the loss distribution. So if you mandated that all the natural perils are covered in your basic HO3 policy, for example, but then the government comes in when losses exceed some set threshold and picks up the claims that would otherwise be bankrupting and also can make the policy then something that people can more likely afford, I think that can work. That's how France and Spain and New Zealand and other countries internationally have gotten more widespread take-up of disaster insurance and handled this sort of pricing the tail risk problem. But to Dave's point and the point on the NFIP and Alex is I absolutely agree that we need an affordability program for lower income families. It's so important that they have insurance coverage and it should be means tested support instead of this across the board kind of cross subsidizing and policy premiums that we're doing right now. And I do want to just make sure people know that the NFIP is moving to property level risk-based rates and modernizing their rating through the use of catastrophe models, fixing some regressive cross subsidies, doing a lot of really important innovation in their risk rating, and that should be rolling out later this fall. But what it doesn't do is still address this problem of low-income people in high-risk areas being able to afford it. And that takes Congress, and the NFIP can't do that on their own. So.
Another point that was mentioned in the chat as well with the low income communities is how many renters there are in the U.S. too, and those problems as well. But Alex, I'll give you the final word.
Yeah. Oh, it feels like an awesome responsibility. No, I mean, I agree. With what Carolyn was saying. Yeah, that their risk rating 2.0, I think, is the name that the NFIP has for this system, and it promises to be a move in the right direction. It's been interesting that they have delayed it at least once, maybe a few times. That the politics really are hard to extract from any change to the National Flood Insurance Program. So, we'll see what happens when letters go out to homeowners informing them about the new rates that they will be paying. They say that it will help, as Carolyn is alluding to, with the problem of people being overcharged, where you have a house that is not actually worth that much, and yet you get a letter saying your flood insurance premium is like 10% of the total value of your home annually, and people just have this sort of reaction. How can that possibly be true? I think it's a fair concern that Dave raises about, once you make this a national program, there's a tendency for Congress to kick in money. The National Flood Insurance Program, I think, worked pretty well on that score until that disastrous year of Katrina and Rita and Wilma. Up until that time, it was able to break even. But I see that that's a concern. But I think there is going to need to be probably a subsidy to help low-income people afford it. And maybe it makes more sense to subsidize the decision to leave and be able to move away from the risk when you choose to. I think it's flashing at us maybe that we're totally out of time. So I'll stop talking now.
Well, thank you so much to the panelists for agreeing to come and talk and for bringing your insightful things. There's lots of comments in the chat about how great your presentations were, and I wholeheartedly agree. So thank you so much, and we'll see you all later.
Thank you.
Thank you.